Good morning, everyone. Good morning, Oleg. Can you hear me, Oleg?
Yes, I can hear you very clearly, and I'm very happy that I have such ability to be here to hear what you and other guys are talking about.
Well, we're glad to have you, of course. Um, I'm traveling again today, so we'll probably keep it to an hour like we did last week. And there's been a lot going on in the markets this week, a lot of choppy trends, of course. I'm trying to hang in there with all of my commodity trades. Pretty surprised that I keep reading about people getting commodity traders getting hurt by some of the commodity moves. So I guess there is long-term trend following commodity trading. There's lots of other kinds of commodity trading as well. Um, Hanging in there in my dollar trade, still long dollar mostly. There was one funny comment I saw on Twitter this week where every currency was lower against the dollar one day, except pretty much except the euro. So the comment was dollar weaker today. When I go on podcast or whatever, it's difficult for me to explain to people, that it's not just the dollar. It's a lot of other currencies floating around, and it's dollar yen, dollar Swiss, and so there's a lot of diversification and a lot of movement going on. It's not just the dollar. So I think the dollar index is overweighted with euro, of course. So that's everybody's idea of what's going on in the dollar. Good morning, Richard. How are you?
G'day, Jerry. How are you? I hope you can hear me. I'm having a bit of trouble with my audio at the moment, but hope all is well, everyone. And it's been a pretty quiet week for me, just doing my normal thing. How's your holiday going, Jerry?
It's going pretty well. I'm at the beach, and it's a beautiful day, and I convinced my wife to let me do the Clubhouse this morning during the middle of our vacation. But she wanted me to mention that she was going to do a boxing class. So she's quite the little athlete. So we have a lot of stuff going on today. It's the least we can do to start the day off properly, start Friday off properly, hanging out with my friends and talking about trend following in the markets. She hears it all day long, though, every day. So she thinks she's pretty much an expert on trend following trading. I bounce a lot of ideas off of her, and she usually agrees with me. No surprise there.
So when you've got a frown on your face, she says something like volatility targeting, Jerry?
Yes, yes, she's heard about that quite a bit, as all of you have too. Just imagine what it must be like 24/7 listening to this stuff.
And I think she likes to talk about risk management rules.
Bruno's back from holiday. How are you, Bruno?
Doing fine. I am glad my systems were working for me while I was enjoying my time in a beautiful Brazilian beaches. uh, I must confess I'm trying to catch my breath here. I'm impressed by the volatility of the markets. Jerry was talking about his commodity and dollar trades. I'm still on most of my grains, but I was shook off my energy trades in the oil. I was shook off from wheat and from soybeans. I think I talked about getting out of the soybean trade last time we were on Clubhouse. But anyway, I'm still on the veggie oils. I'm still on corn. I'm glad I'm there. I'm glad I'm there. I'm glad my system is still on these markets. Yeah, I would like to know if you guys are still on, or were you shook off like many of my trades?
Yeah, look, personally, I lost a few, but because I'm running these multiple systems, there's still a few alive on each of these markets. So no market's written me off totally, but wheat gave back a couple of systems and Brent and crude, but I'm still holding on with a couple of them.
Yeah, and as you know, I trade those long-term breakout systems. So the volatility doesn't really shake me out, or the profit give back. I measure from the lows, not from the highs. And the breakouts, one of the things about the moving averages is they tend to move up every day. When you have an uptrend, your trailing stop kind of moves up with the profit. But with the breakouts, it doesn't have a tendency to do that. So it's a lot of all or nothing for me. I'm going to be the biggest hero ever on trades like these, or I'm going to have the biggest give back and not make as much possibly as other people. But I gotta. So when I'm traveling and when I late at night, if you see these tweets come across, it's usually because I'm enjoying some really good wines. And then I pick up the phone, I start tweeting, and it just gets out of control. So last night I tweeted something about, oh, your trend following rules should only be based on breakouts and moving averages, and not volatility of the trade or portfolio or the P&L. The P&L and the trade should not make you move, change, or stop, or really help you even calculate the stop or the trailing stop. So I got a lot of positive response, but I did cop to the idea that I was drinking heavily. And but so I think that, yeah, it's really a bummer, these markets. It's hard to enjoy. I like it when they go up a lot rather than when they go down. And the profit give back and ruble. I still have ruble. I did spread my nickel. I think nickel's been limited down a few days in a row. And so that's like no fun, giving back all those profits so violently, and your brain starts telling you, well, it's really going to go back to where it was a year ago pretty quickly if it keeps up like this. But sometimes it works out like the emissions. I did not get bounced out of emissions. I think I said I did get bounced out of some, but I did not. And so you can go look at that emissions chart. That's a pretty darn good sell-off. And I got close to being bounced out, but I didn't. So you can see my trailing stops are pretty far away. And look, when you do the back test, if these long-term breakouts didn't work, I wouldn't do them. It just works overall, but I'm not sure how it's going to work in 2022. That's the price we pay.
Yeah, I read your tweet and I agree completely. I just haven't the ability to figure out how to build these systems that exploit so good so well the long-term trends. And to be honest, my most important take of this tweet was that phrase you keep on repeating: do the right thing, do the hard thing. And thanks for that, Jerry, by the way.
You're breaking up a little bit. I didn't hear the phrase.
Oh, I'm sorry. It's that one. Do the hard thing, do the right thing.
That's right. I mean, that was a familiar refrain we heard a lot in 1983, 84, 85, And then that helps you answer a lot of questions. And then when you start going down the path of research or thinking about how to adjust your models and should I do this, should I do that, then having that sort of attitude, that's going to head you in the right direction. I wonder if I can get out near the high, if I can reduce vol. I wonder if reducing vol is a good idea, you know. And so you're kind of like, oh yeah, that doesn't sound like the hard thing, does it? So yes, those little sayings are sort of invaluable to me to keep my head straight and to realize, how tough it's going to be. And then, you live through these things year after year after year, and you remember a lot of the bad give backs and volatility, and then you look at the performance, and you're like, oh, okay, the performance isn't that bad. And that's whatever it takes to maximize those returns is what I try to do. And I think when you build these systems, I mean, we've been pretty clear that breakout systems where the average holding period is a year or so. I mentioned this on Neil's podcast. Was just trying to sum it up. How do I sum up what you're looking for? Richard talks about these endogenous moves taking a year or two or three to play out. So I think that's probably why when you do a back test and you start playing around with the different lengths of the breakouts, you sort of see that the optimal parameters can be parameters that keep you in the trade for a year or two, and on average about a year. So, this is what I tried to do. And so I think part of the problem of trying to figure out which parameters to choose could be, well, look at that drawdown. Well, that certainly can't be the answer. Look at that volatility. Look at some of these trades. Overall, it's a good money-making idea, but there's numerous trades or numerous years where I would have, it just doesn't seem right to give back all that profit to sit there with all that open trade equity. And so that cannot be the right solution. And I think that's certainly the idea that most people have, that that's why you see such portfolio management, risk management, volatility targeting, because it really is just the worst ride. It is so doing the hard thing. This is the hard thing on steroids.
I like this word very much. It's really very important secrets of trend following here from Jerry, and I appreciate it much. And I want to say that I like the idea of Niels and Jerry said this, and Moritz, of investment horizon. So, in fact, this investment horizon, maybe trend following looks uncomfortable for people. Of course, I understand all this stuff, but investment horizon is looks good here. It's not very long, maybe. As I remember, Moritz said that it's near 4 years for trend following. When you can analyze, but of course we all understand that it can be more for a particular system or strategy, maybe more or less, maybe from, and as I know, from 3 for 5 years, Jerry said once. And okay, but if we are talking about stocks, about buy and hold stocks, it's for example, I saw the chart. It's not a problem to see the chart, and we can all see the charts of the stocks. And for example, the chart of Russian Gazprom was at the price of Gazprom was in its high in 2013, and it came to that point. Then the price get down, and it came to the point to that level of the price only in 8 or 9 years. I don't trade this because so I don't know exactly, but in fact, for buy and hold strategy, but if you come to some investments banks, in Russia at least, I know such bank, when my friend came to a bank and a manager said to him, here is a very good price, Nornickel, very good stock. If you buy this stock, you will be very, maybe, rich man or something like that. And he asked me, is it a good idea? And I said, no, it's a bad idea. It's a bad idea of undiversified portfolio. And he was very thankful for me because it was before Corona crisis. So his nervous system would be not in a very good shape after that. So, of course, and people don't understand. So the people think that there is a science of analyzing the stocks picking the stock, and the manager will help you, a client, to pick a stock, and these stocks will go to the moon because manager knows how to predict this and all of this. But in fact, you can be for 8 or 9 years, you can be in your performance will be negative 8 or 9 years, or maybe 10 years. And as Neil said and Jerry said, I remember it exactly, that we can not see such a bad performance for a trend following strategies. And I like this idea very much.
Yeah, when someone asks for an opinion of a stock from me, had last year was 49%, so it was below 50% win rate that I'm often, even though the overall performance last year was almost 30% on my whole portfolio, but still I was.
Trend following, like Jerry said, we often wrong in our trend following trades, but I want to say that it's okay. It's a part of a system to be wrong in your trend following trade, because we cut losses short and we let winners run. And if you are wrong in your prediction model, it can be very costly.
Hi, everyone. I'm so happy to be here as always. And last night I was reading the notes, the Twitter from Oleg. And Oleg, you wrote down the conversation of Jerry with Niels. I think it's for Top Traders Unplugged. Here's my question. Jerry said, okay, multiple entry and exit has performed so well for me for many, many years. So Jerry, here's my question. My understanding in this conversation, you mean multiple entry and exit? Does that mean, okay, when the stock has been stopped out and then you come back? Is that right? Is my understanding right? Thank you.
Hi, Lulu. Well, what I meant by that was I trade, let's say, 4 different systems. They're all trend following. So each one of the systems has a different entry and a different exit. So one might be the 50-day high. I get into the 50-day high. And then the next system, I would get in at the 75-day high. So that's what I meant by trading multiple systems with one entry, an exit, and then a stop loss. And so it'll give you some diversification. You can, if the market keeps going your way, you'll keep piecing it in, possibly higher and higher. And then if it goes against you on the first system, maybe that's the only system you get in. So you'll not have a full position initially unless it shows some trend. So I think, and it's especially important on the exits, where sometimes on the entries they can all bunch up together, the breakout entries, but on the exits, especially some of the markets we have big profits in now, the multiple exits from the different systems will diversify your profit on these trades. And some of them you'll get knocked out of, it'll keep going lower, and some of them you'll get knocked out of, it'll go back to make new highs. It's just a total given, changing the subject slightly, that when you get knocked out for stop loss reasons or the breakout exit reason, you have to get back in if it goes back to the highs, for instance, and your entry criteria is satisfied. So we're always getting in and getting out, and but never letting the system, the trend, get away from us, and we're always having a position when it looks like that trend is starting up again. I just want to remind you that the room chat is open, and there's a question in there now from Andrew. And Andrew's question is a question on stops. If your system is long-term and you want to stay in the trade, what then is the purpose of the stop? And do you get back in if you're stopped out? Yes, you always get back in. And I think that's one of the, I think I asked Rich that one day in 1983, Rich number one, old Rich, not new Rich. What's the biggest mistake that you'll make as a trader? And he said, not getting back in. You got to get back in. Taking a lot of losses in a row, or getting exited out of a trade that's profitable, only to see it go right back to the highs again. You've definitely got to always get back in. And you can't have any sort of filters on your systems that keep you from getting in. The entries are very important. If you don't get in, you're not going to make the money in the big outlier. But I think the question here that he's asking is, only thing I could think of is maybe I was confusing about stops. So when I say stops, I usually mean stop loss. I need to be better, more specific. So the stop loss is when you put a trade on, you have your ATR based stop set at a certain level, and then that's going to produce, if it gets down there, it's going to produce a small loss based upon your overall assets that you're managing. And so you want to keep those losses small. And then I like to have my trailing stop far away from the market, 100-day lower minimum, nothing quicker than that. So that keeps me in the trade long term, even though on the losses I may get out much quicker and I have to keep those losses small.
Jerry, this is Brian. Do you? I know I'll trade the front month, but then I'll say also for grains trade the new crop as well. Do you trade multi-duration, different contracts within the same instrument?
That's a good point. I think you need to watch that and see if there is something going on there, and that's an opportunity where in this particular example, the front month and the old crop and new crop, if they're materially different, you should take advantage of that and be in both of them if they're both trending, or be in the one that maybe is the strongest. But I think looking at these type of things in the commodities is a very good idea. And I do look at that. And I was reading a lot of stuff over the past year about the cattle and the hogs being in kind of a bull market. And then I think I was short most of the time, and I couldn't understand. And I think that on the cash market, there's something going on, and maybe in the futures market, something else is going on. So within the different future market options, there's things going on that are different. So I think paying attention to that and looking at that, and I use continuous contracts, of course, but then I will also go through the charts contract based. So it takes out the continuous, and I want to see December, March, June, September, and I scroll through those to see what's going on, see what's happening, because sometimes the continuous contract or the lead month, just focusing on that, you'll miss some things, especially in the commodities. And I'm focused on that on the short-term interest rates as well. Which ones are the weakest in this environment? So I'm trying to think of some others, but yeah. Well, you can also pick up that stuff in the energy, heating oil, crude, unleaded, natural gas, seeing those the front months. So I think it's a good point. Pay attention to all of the different months. Some things could be happening and going on that you'll not see if you're too focused on the continuous contract.
Yeah, interest rates as well. The 2-year forward can be completely different from the 5-year forward. That can be completely different from the 10-year. These quote-unquote calendar spreads of interest rates can have some meaningfully different behavior. Jerry, you were talking about your 4 different systems, and I'm as you guys don't know, I'm in a perpetual job of trying to improve my own systems here, and I do feel I have a lot of a long path to to walk. And well, I try to understand what the combinations of entry and exits can have, what different performance, different combinations of entry and exits can have. And it's kind of overwhelming because there are so many of them. And then I developed a notion that longer term entries should match longer term exits. I mean, it makes more sense for the 200-day entry be matched with a longer term exit, I don't know, 150-day, than it is to be matched with a 25-day be matched with a 25th day exit. Do you guys think this make any sense, or is it just my predictive mind trying to find some signal where there is none?
I tend to agree with you, Bruno, with your logic there, but I confirm that logic with my testing. So what I do find is that if I do extend my look back, then my most productive signals are when the ATR on my stops and trailing stops also extend as well. So there does seem to be sort of like a symmetry there in terms of look back and the length of exit or your holding period. So yeah, I think it does make sense. But what I do is, as opposed to just making a decision based on what you think is sound logic, I'd definitely put the data through it to make sure that it's valid.
Yeah, definitely. The thing is, if I put all my ideas on the data, I won't be able to analyze it all. I have to start from some basic point that's not too basic, you know?
Yeah, but I think we've got that. You know, we've got the one entry, the one stop, the one exit or the trail. We've got a breakout system, a simple system like a Donchian breakout, or we might have a Bollinger Band breakout as an alternate system, or some other form of breakout. Like I do like the sort of idea of making sure that there is a complement of breakouts in your system suite. You might entertain other forms of trend following model, but more as supplements as opposed to the main arsenal. The breakouts are essential to ensure that you do catch those outliers. So these very simple systems with maybe 6 or 7 parameter variables, that's it. Then you just let the data tell you what those variable settings should be using these extensive data sets. So rather than making a logic-based decision, you pass these simple models over extensive data sets where you're not only testing it across the market you want to trade these on, but also alternate markets as well, because it should be a universal principle that's applicable to any liquid market. That lifts your sample size, and that should be able to narrow down what are the better settings to use, and without being overfit.
Yeah, thanks.
And I tend to, for all these years, I have tended to follow that same idea, Bruno. 200, pair that with 150, 150 entry, pair that with 125. Or I like that. I think it's important to have a period to give for the system to have the possibility to be flat. And so, with the exit trailing stop less the parameter being smaller than the entry, you will have a situation where you'll be frequently flat a market. So you're going from long to flat to short. Not every time, but I probably have a bias against systems that are never flat. I don't remember why. I was probably told that, and I don't remember why. Now, Richard has mentioned
Jerry,
that
when you say flat, do you mean inactive, or how do you mean when you say flat?
no position. So long soybeans. When I get out of the soybean trade, I don't immediately go short.
Gotcha. Thanks, Jerry.
Yeah, if I get it, to achieve that, the the exit breakout must be a lower number than the entry, right? Because if you're supposedly your exit is the 200-day breakout and the entry is 150, and the market goes against you, your new entry would be triggered before the exit. And I agree with that, Jerry, and that actually would be my next question, because it makes everything more consistent. If your exit breakout is further away than your next entry, then what you do? You exit first and immediately enter or what? Get it?
Yes, yes, you're right. And that's what I was trying to say. And this can be kind of a complex thing to discuss, but it's kind of it's not worth really getting into. But I have tried lots of different combinations where, so essentially, what you're saying, if your next entry is going to be your exit, actually, so there's no such thing as a 100-day entry and a 200-day exit. It's just going to be a 100-day entry and a 100-day exit, because the or there's other things you can do. I have run long systems and I've run short systems. I wasn't quite doing what we're talking about, but it was very similar. So I have set up my computer to run system one was long and system one shorts, and so that's way too complex and it doesn't really help. But we had a lot of time on our hands. We had fast computers. We were trying everything and anything, and just trying to be cute. So another thing I think is very important, which is very obvious, is within these multiple entry, multiple exit idea. It's, for instance, it's 4 discrete systems that are doing their own thing and are not paying any attention to the other systems. They don't even know the other systems exist. And it's one entry, breakout, one exit, breakout exit, trailing stop, and then one stop loss to keep the losses small. And then you can have 4 of those, or 5 of those, or 10 or 100 of those. Okay. But it's very important not to think that I'll just have one system with all of these exits. And the system will choose which exit to use, and based on certain conditions. And I think that's where you're in lots of trouble, overfitting and not being consistent in the same way that it is when you're trading these 4 independent systems independently. And I know we've had these discussions on Top Traders Unplugged, and that's a big issue for me, is that each system can only have one trailing stop exit. You don't want to base your exit, I'll get out to the 100-day low unless it's a big profit. Then I'll make it the 50-day low. So that's no good. Have a 50-day low system, that's fine, and a 100-day low system, that's fine. But you don't combine all these entries and exits into, you're just crushing your sample size. And I think that's fairly understandable.
Jerry, I really enjoyed your podcast with Niels last Saturday. There was some really good stuff you brought up, which was quite new. Particularly, you've gone a bit further in your strategies that you deploy for your equities markets, where you're long single equity markets, but you're short indices. I really like that idea. Can you explain that more and how you came to that conclusion?
Well, honestly, I've been doing that for a long time, 20 years. And it's just understanding the diversification that you're going to get from trading single markets and not trading indices. So I wouldn't trade the dollar index or a commodity index, so I don't want to trade a stock index. And then I can build the portfolio the way I want to, with lots more diversification. I can size the trades individually based upon their own ATR. So there's no doubt that it's going to be better for to trade individual stocks. And mix that in with the rest of your trend following portfolio of commodities, currencies, and bonds. And then we noticed on the back test that the short stock, individual stocks were not very profitable, and the indices were very profitable, and we decided to do this combo. The stocks have a unique characteristic that the other markets don't have. There's always exceptions, of course, to this, but in general, the volatility is very high in single stocks as a percentage of their price. So when you go short a stock and you put it on based on the ATR sizing method, you can pretty much, most of them see that if the stock goes to zero, it's not going to be an outlier. So we're hunting these outliers. We know going in, unless it goes negative, if things don't go negative, oh, wait a second. Yeah, sometimes they do. I don't think stocks.
A couple of times.
That's right. I don't think stocks can go negative, can they? I don't know. So this is what we noticed, and we ran a lot of testing, and it was just not a profitable thing. Although, I've been on record of trading certain markets that historically haven't been profitable. I think that stocks are hugely profitable on the upside, and looking at lots and lots of data, we felt like we had a fundamental reason that they were not going to be very profitable on the downside. And then I abandoned that idea for a few years for some reason. That's a long discussion. And then recently, though, within the past year or so, when I was asking you some questions, Richard, offline or online, I don't remember, probably both. And your response was, oh, I asked you, number one, don't you see in the stock data better outlier possibilities or better outliers in the data, in the historical data, with the individual stocks than with the indices? And you confirmed that. And then I also asked you, what do you think about shorting these indices? And your response was, I do see more outliers shorting those indices because, in your words, it was more like when the stocks get highly correlated and the correlation goes to 1, you will see this rapid kind of crazy sell-off. Yeah. So you encouraged me again to pick that back up, that strategy, and adopt that again. So I think it all revolves around this outlier thing to me, and it always has. And then just meeting you reemphasized it even more. Get back to your roots, Jerry, and think along those terms. And so that's why I do that. And it's been a pretty good, profitable situation. Now, yeah, so that's enough about that, but that's what I've been thinking. I could go on, but I kept forgetting to say one other thing to Bruno about selecting systems, and that is at some level in between, certain parameters, all of these systems, they make the same amount of money. So there is not this agonizing choice to be made, because from 100 to 300 on the entry side, and on the exit side, I think maybe 300 is too long term, maybe it's not. But I think you'll find that when you start seeing these parameters where all the systems basically make the same amount of money in the back test over a 30-year period, not on an annual basis, but you'll start to see, okay, so there isn't a big choice here. I could get lucky or unlucky, of course, but you can sort of relax and say, okay, I'm just going to trade 4 systems, 2 systems. I think back in the turtle days, we traded 2. I've traded as many as 100. Totally unnecessary, but it's really not an agonizing choice. There's so many of these parameters that'll stare you in the face. You can't miss them. And it's just basically saying you can't find something that's not going to make money in a trend following way. You can be too short term or too long term, granted. And that's not the issue, though. The issue is, yes, you're right. And yes, they make good money. They are so ridiculously volatile. And to do this, when you say do the hard thing, this is outrageous. I'm not going to sit there with wheat like this. This is nuts. And all I could say is, I feel your pain but try to train yourself to have that discipline to follow these systems. They'll give you money as long as you don't ask them to do too much. Like, I want the money to be fit my personality. My personality is ease, comfort, and pleasure, and a really nice non-volatile equity curve. That, you wouldn't raise your children that way. Oh, life should be very easy. Life should be the way you like it. Go to a college where you don't have to study very much, and it'll be the same. And so I think this is silly. And if you're fortunate enough to get money out of the markets and survive, that's all you should probably be asking for, versus doing it on your own terms, because my terms would be ridiculous and unprofitable.
Yeah, thanks, Jerry. Thanks a lot.
Something that I tested myself and made up a decision with shorting single equities was that, and probably many of you trend followers don't accept this view, but I found that often when shorting single equities, it's going to be better to exit into the weakness and not wait for the reversal like I wait for when I go long with a trend following system, and try to stay in as long as it goes, and not worrying about the pullbacks. Then when thinking about shorting, I found out that it's often better just to get out when it's stretched out to the downside enough. So here is just the word enough.
So, Marcus, do you have profit targets there with your short positions?
Basically, yeah, I don't short too much, but and I also lately started to look at shorting sector ETFs or CFDs instead of single equities. But yeah, basically a target profit target when it gets really stretched out to the downside, because in equities there's gonna be these bounces back, mean reversion, and all kinds of that stuff.
I was just going to point out, Marcus, that you got to also look at, it's kind of a different market. The past 5 years, these V-shaped bottoms, and I think someone else could probably speak better to it, but it seems like that's kind of a new feature of the markets. So where once you give it second thought to covering, it's already launched upward, and that might not always be the case.
Yeah, that makes sense, and something to think about, that it maybe it won't be like that going into the future, that we always have this V-shape recovery. So yeah, definitely something to think about, and just be prepared to have these new lows and some bounce back, and the new low and the new low, and so forth.
But right back to what Jerry just said, if you are taking money out of the market, that's a good thing.
Someone tweeted something the other day, something about this is what typically happens, and I said, I responded like, I think my 35-year career is sort of built on not expecting the typical to happen, and so I think that you don't want to get into this patterns. I think it could last forever, and these V bottoms, I don't know, but there could be a lot of opportunities missed if you if you rely upon these patterns reoccurring. And then in March of 2020, February 2020, like I think I was long like every stock, and I think all the stocks were in this big uptrend, the vast majority. And then everything got crushed. I've gone through so much data looking back over that period that the chart patterns were all so similar. You got out, you got in a long ways from the bottom, you got all the short trades were like losing trades pretty much. And so that is very unfortunate. And then, so if you're looking at the index, that was bad. Looking at the individual stocks, those were bad. Now, over the past year or so, much different. Half of my stocks are in a downtrend. They've been downtrending for a long time. They're still in downtrends. They're really nice, little smooth downtrends. And then the other half of my stocks are doing their own thing, uptrends, going nowhere. And so it does seem like now it's a much different situation than what we've had with some of those V bottoms, where it was just no way, the trend following was just destined, doomed to underperform and not help at all with trading the stocks. So I think now we're in a different situation where if the stocks stop going up, we're going to get some fresh longs because I think the majority of a lot of the stocks outside of the ones that drive the index have been doing their own thing and been in downtrends for quite a while.
Yeah, I'd agree with that, Jerry. It's a fundamentally different regime to what it was back in February 2020. I look back to that period where everything was correlated, and I'm sort of thinking that was sort of like the expression of the tail end of this regulated, highly regulated, low volatility environment where, to undo or decouple from that regime, we experience this massive correlation across everything to just get rid of it from the markets. But yeah, it's interesting what you say. Listen, I was also very interested to hear with Niels that you are so confident about the trend following way these days that we don't even have to research anymore. Is that right?
That's right. I think I even told Niels I was trying to think of something controversial to say, and that's the best I could come up with.
Well, that was more controversial than Andreas Klenow saying you can't trend follow stocks.
And I like it very much. It's almost all I hear from you and Niels. I like it. But really, I also said before that, firstly, we must have a maximum, of course, data, maximum information about the subject, about our trend following systems, how it works. As Jerry said, how it handle the trades, handle trends, how it handle drawdowns, capture trends and handle drawdowns. Maybe it's better to say. And I think for me personally, as I said before, it's very important to understand how my strategy organized. And in case with trend following, I understand this. I understand maybe not all, of course. I'm not a 100% expert in trend following. Of course, I don't know all the factors where it works, but I know enough. And it's enough for me to trust trend following program strategies and to be confident in it and to follow my rules in a disciplined way. It's enough for me, my knowledge about this subject. So, and our rules are universal for all the markets. Universal in all the market. I have heard from Niels that weeks have another behavior, but for all the markets we can see the same. I don't know about the weeks, I don't know this, but we see in all the markets, we see one picture, and as I have said before many times, we see here is, I think, the laws of nature get worked, and we see the same in many different structures, many different systems, not only financial systems, but in weather, in weather, in a lot of something like that. So I think that, of course, research is very good, but I liked this idea. I like this idea that it can be enough research, because there are some things that can be changed in the market, and there are some things that the part of a market of structure of the price. So it's based principles of how the price works, and I'm sure that trend following system is based on this. And so really, of course, we must have here a lot of data, a lot of thing. Of course, in all we do, we must test what we trade what we test. But I agree that for me, firstly, as I said today, a few minutes ago, for me, firstly, I must understand how the system works, and it's even more important than maybe 100 years data, because theoretically the environment can be changed, and even if theoretically I have a system where I can see 100, 200 years of a very perfect data every month, this system give me, for example, 10% a month consistently, but environment can change and I can lose all my money. And I don't see such a situation with the trend following.
Well, let me see if I can sum this up. I would like for people to criticize this and point out any issues, but since I'm dedicated to using all of the data and I add a year's worth of data every year, the likelihood that my parameters are going to materially change is low. And then okay, look, so if 5% of the trades are making all of this money, 5 or 10%, and all the other systems and parameter sets, they're pretty much going to handle the small winners and small losers about the same way. This is not going to be the 100-day breakout versus the 150-day breakout. I mean, it's probably going to be about the same with 95 or 90% of the trades. So I'm left with my performance is dominated historically, and oh my gosh, in the future, this crazy world we're in with these outlier trades, and it's such a small number of them that what kind of comfort am I really getting by rerunning this data all the time to see if the parameter has changed from 100 to 112, right? So I do think there could be a time where I say, I'm seeing some material underperformance in the longest term system or the shortest term system. So maybe the markets have changed a bit and I need to go a little bit longer term on my shortest term system. It keeps getting bounced out. It's the volatility, the typical trade is wheat now. And so I'll sort of see that and maybe get rid of my shortest term system. But I think from a entry exit trend following point of view, I just don't, my shortest term system is still very painful. It's still in wheat. My God, that's like the litmus test. It's still going to give back a lot of money in crude. So it is doing the hard thing. I could see possibly that having this epiphany that to ignore 95% of the data historically, something that I really don't want to do. And you see this when people talk about research too. They talk about overweighting recent data. So if you have to start from something that I don't believe in order to put this huge value on rerunning parameters all the time. And then I think another thing that encouraged me was this endogenous exogenous idea of these trends take a year or two to play out. 90% of our trends are endogenous. It will take a year, multiple years for some of them to play out. I think I'm in a good spot. I just don't see the value. And what's really going to make my day? What's really going to make me special? Finding the perfect place to get out of this crude or this wheat. Well, that's impossible. And it's the next wheat trade or crude trade. I'll be just as I'll be in the same situation. I'll not really know if any of my systems will handle them optimally. I should have chosen a fifth system 173.2 days or something. That was the perfect system. So I just think it's a fool's errand to chase after these parameters when it's all going to happen in the future. And seriously, this crude trade is where the best place to get out of this crude trade is going to be told to me by historical data. Yeah, I guess I don't really think that that's the case. The edge I have is I'm doing a lot of things pretty good, and I'm doggedly consistent in trading these parameters, and I'll get my fair share of good stuff because I'm going to trade a robust set of rules, very few parameters, and I'm going to not change them. I'm not going to change them. And that is so powerful to keep the same methodology going over multiple decades. And I have experienced the cost of frequent change due to this research process. So, yeah, so I don't know if I made all my points, but entry, exit, parameter, backtesting for trend following, I don't think I'm not saying I won't ever do it. I just don't think it's probably necessary. And logically, I don't see how it really takes me to another level.
I totally agree with those sentiments, Jerry. And I think that in this particular world we exist in, this trend following world, it's very pertinent what you say. It's not to be confused, however, with different techniques like convergent methodologies that are relying on the specific nature of each individual market's characteristics. What we're focusing on are these outliers. So profits need to be underfit. Because these outliers are anomalies that haven't been experienced in the past, we can't afford to overfit in any way, shape, or form our profits. Losses are losses, which is a consequence of risk. I think probably sample size does come into it, very, very much so, but universally across all liquid markets. So therefore, if we are going to change our models, it's a very infrequent exercise, maybe once in a blue moon, like every 10 years or something, but we probably do need some form of small adaptive process in our workflow process itself that ensures that over the course of a very long duration of a career, you might be tampering with your models maybe 2 or 3 times. That's about it. I was interested, back in your turtle days when you were trading the faster models, how you came to the conclusion that you needed to step out your lookbacks to sort of longer lookbacks after the turtle days, and I was wondering whether that was a case of you in the turtle days lacking the sort of the sample size to make that decision of the longer term look back, or whether it was a consequence of markets changing. I'd be interested to hear your feedback there.
Well, back in those days, we didn't have the ability to generate our own research. And so we were told what to trade and how to trade. And from day one, System 1 was shorter term than System 2, but everybody thought System 2 was getting better. So there was, from day one, there was this idea of maybe a bit longer term is better. But then I would just, as I started Chesapeake, and I would look at charts and do research. And as I've said before, the back testing would show, when we started doing my own back testing, would show that medium term and longer term were just as good as the turtle short term. And the turtle short term was getting worse and worse. And I think a lot of it, the turtle systems and the parameters were based upon personality preferences and not hardcore backtesting. And as long as they could get away with the shorter term, they wanted to do it. And shorter term is better. If you could make the same amount of money trading shorter term, then that's what you should do, because we always had one entry, one exit, and a stop loss. So, but with that as the limitation, it's hard to find short-term systems that make as much money as the medium to longer term. So, the longer term was always as good or better, and that's what I found very comforting. But we could just see on a daily basis that I would bring up charts and put a channel on the chart and put a 20-day channel, a 50-day channel, a 100-day channel. And if you're trading something like 20 or 50-day breakouts, if you step back, you see a trend that's lasted a year or two, and you got chopped up. And it's like, well, I don't like getting chopped up. I would take those little drawdowns in that chart, and I would prefer to make the most amount of money. And so visually, I saw it on the charts, and then I confirmed it with a back test. So I wish I could trade short term, wish I could find short term, 20-day, 50-day breakouts, but I don't think that is optimal in an endogenous world.
Yeah, that makes a lot of sense. And where we might differ with Harold is that I think these different forms of trend following aren't necessarily capturing the same edge that we are. We are definitely focused towards these outliers. Some of the other trend following programs are targeting something different, and I can therefore see why research might be applicable to what they're doing. But yeah, I tend to agree with you, Jerry, and I think you almost get to a happy place where you realize that the only form of research you really need to do is how to identify new market opportunities, how to increase your diversification. I notice you're up to 170 markets. That's an amazing accomplishment. So it would be a very nice place to be in, where that was your only consideration. What new market opportunities that offer sort of some unique quality in this liquid data universe do we trade?
That's right. I spent a lot of time and energy on identifying the markets, finding them, seeing how they fit in. Do I think it's going to have a good chance for an outlier move? So that's a lot of good work. And then I'll pull out my spreadsheet sometimes to some of the calculations that I've been using over the years, and see if I can improve those in a backtest way and get it confirmed in other ways as well. I'm not adverse to, for instance, I would not allow a big profit to turn into a loss. So, I mean, one of the biggest profits of all time, let's say Tesla, Moderna, I think my system, actually, if I followed it, it may give back all the profit sometimes. And so I would not allow that. And so since that, I would need a rule that had almost zero sample size. We had almost no sample size whatsoever. Why would I bother with the back test? I would just say to myself, I'm not going to give back all this profit. I'm going to make sure I keep some. What kind of rule can I come up with that doesn't interfere too often with my tried and true breakout with a large sample size? I'm not going to kid myself and pretend that to optimize some sort of parameter where this has happened on 5 trades, where I had a 100, 200, 300 ATR profit, and all of it went away. I think that has happened historically a few times. So I just come up with some rule, admit to myself it's just there for this crazy occurrence where I could give back way too much profit, and it's probably going to make less money overall. And it has nothing to do with backtesting or research. It's just me having this rule, plugging it into my computer, and off we go. I think just another comment I want to make on research. I think research is a great marketing idea. Oh my gosh, it's one of the best marketing ideas ever. Markets are always changing. They're always evolving. We have to use new data, AI, ML, and then they go down this route. And then every now and then, the trends take over, the markets take over, The simple breakouts make way more money, and you sit there going, "What the hell was I doing? What's important here? Tweaking my entry and exit, or being long crude, heating oil, soybeans, and short interest rates? What's really driving this engine here? It's those trends, not tweaking my parameters."
Yeah, I was saying amen to that, to Jerry's talk, and I wanted to say about the pattern thing and about the COVID crash March 2020 that was brought up earlier. That I don't look at these patterns myself, and I always use like a systematic way of some channel or moving average or something to make a decision. And this was a very good educative. Time in March 2020 when my stops got hit at the end of February and early March, and I was basically in cash in March, looking from the sideline what was going on, and and all the discretionary traders, on Twitter were telling now you need to wait for the second bottom and a retest of the lows and or a higher low forming out, and none of this happened. It was a V shape, and I don't care if it's a V shape or not. I just started buying stocks again in April and May, and more of that in June. Not and I felt so bad to make any purchase in April. I was so like my stomach told that it's gonna be a loser, but I need to take the trade because my system told me so. And yeah, later in hindsight, we all saw the V bottom recovery, but at the time it was so hard to make the decisions, and I made them because of my rules, not because of some discretionary gut feel.
Yeah, good for you. I think that's like the most important thing about trading is just implement your rules. Figure out, get to a situation as quickly as possible where you can implement your rules that are loose fit. That can handle these situations you've never seen before, situations that are not necessarily in the back test, and be prepared to implement those rules on a daily basis for the rest of your life. That is so much power. You could have a very mediocre approach, not 170 markets, not the best approach, but you'll outperform most, because that's really the difficulty, is doing those trades. It always has been, and it always will be, and trying to ignore the obvious. I can't tell you how many times people have called me up and said, "Well, that's a pretty obvious trade." Just don't have that mindset. And sometimes they're right. They were right. But it's nothing more powerful than diversification. Loose a system that allows you to hang into these trends and have this mentality. I mean, who has this mentality? And that is that I'm very worried I'm going to get knocked out too quickly. Nobody. I mean, nobody. And yet that's what the data says. Be very concerned that you get knocked out too quickly. And who has that mentality with crude and nickel and what else? There's other markets out there too. Yeah, Tesla, and wheat. Who has this mentality? No, the mentality is the exact opposite. I can't believe I'm going to give back all this profit. This is just nerve-wracking. I feel so good that I'm on the sidelines. Well, that doesn't sound like the hard thing. And if you feel good, that's the third thing. Try never to feel too good, because you're warring against your human emotions. You built this systematic approach that basically is diametrically opposed to the human emotions. You don't have to really understand all this stuff, but I just think as a psychological thing, try to talk yourself into really believing what the data is showing you, which is you should be way more concerned about being out of some of these markets than your concern was to book that profit. And I remember Rich saying, like, just something happens to our brain if it's a small profit versus a small loss. Our brain just really craves that positive feedback. You're good, Jerry. you're a great guy. You had that small winner. I did a back test once, and we said to the computer, don't get out of a losing trade unless it's the full amount of our max loss. So if the 100-day low got hit, but it was only a small loss, we wanted the loss to be even greater. Like it had to be the full stop loss amount of the loss. And that just added a little bit of profit to our average trade. So all sorts of trendy things like that, and trying to do the opposite of what most people would want to do. It adds a little bit of edge to your trading. Just this total sellout and pursuit of doing the hard thing, doing the thing that your brain really does not want to do. I mean, I'm not great at it or good at it. I'm just saying I'm much better talking about it than actually implementing it.
Brilliant words, very important, and then I'm sure that it will be also brilliant maybe in 100, 200 years in the future, maybe 1,000 years in the future. I'm absolutely sure that it is so, that these words, this principle, do the right thing, do the hard thing, it's this principle is priceless. It's a great principle in almost maybe all areas of our being, our life, and it's really great.
Thanks, Oleg. Okay, I'm going to keep to my word and get out of here in an hour and 15 minutes. And it's good to be with everybody, and hope everybody has a good weekend. And we'll be back to normal next week, hopefully. So have a good weekend, everybody.
Have a great weekend. Thanks.
Take care.
See you.
Bye.
Take care.
Bye,
Bye.
everyone. Have a good week.